Strategy 1. ABT Pattern. The ABT pattern is one of the most basic and easiest patterns to trade, and it is an excellent choice for beginner and intermediate traders. Although it is simple and has been known for a long time, it still works effectively because so many traders are still trading it. You should do whatever all of the other traders are doing because a trend is your friend. A trend may very well be your only friend in the market. Let's take a look at this pattern in Figure 7.1. Figure 7.1- example of an ABT pattern. ABT patterns start with a strong upward move. Buyers are aggressively buying a stock from point A and making constantly new highs of the day. You want to enter the trade, but you should not chase the trade, because at point B it is very extended and already at a high price. In addition, you cannot say where your stop loss should be. You must never enter a trade without knowing where your stop is. At point B, traders who bought the stock earlier start slowly selling it for profit and the price comes down. You should still not enter the trade because you do not know where the bottom of this pullback will be. However, if you see that the price does not come down from a certain level, such as point C, it means that the stock has found a potential support. Therefore, you can plan your trade and set up stops and a profit-taking point. The above screenshot, marked as Figure 7.1, is of Ocean Power Technologies Inc. at July 22, 2016, when they announced that they had a new $50 million contract to build a new ship. The stock surged up from $7.70 to $9.40 at around 9:40 a.m. along with many other traders who missed the first push higher, waited for point B, and then a confirmation that the stock wasn't going to go lower than a certain price. When I saw that point C was holding as a support, and that buyers would not let the stock price go any lower than $8.10, I bought 1,000 shares of OP near C. With my stop being a break below point C, I knew that when the price went higher, closer to B, buyers would jump on massively. As I mentioned before, the ABT pattern is a very classic strategy and many retail traders look for it. Close to point D, the volume suddenly spiked, which meant that many more traders were jumping into the trade. My profit target was when the stock made a new low on a 5-minute chart, which was a sign of weakness. As you can see in Figure 7.1, OPT had a nice run up to around $12 and showed weakness by making a new low on a 5-minute chart at around $11.60. That is when I sold all of my position. Figure 7.2 is another example, this time for SPU on August 29, 2016. There are actually two ABT patterns in this example. I marked the second one as ABT pattern. Usually, as the trading day progresses, volumes become lower and therefore the second pattern is smaller in size. Please note that you will always have high volumes at points B and D. Figure 7.2- example of ABT pattern and ABT pattern. To summarize my trading strategy for the ABT pattern. 1. When I observe with my scanner or I'm advised by someone in orchard room that a stock is surging up from point A and reaching a significant new high for the day, I wait to see if the price makes a support higher than point A. I call this point C. I do not jump into the trade right away. 2. I watch the stock during its consolidation period. I choose my share size and stop and exit strategy. 3. When I see that the price is holding support at level C, I enter that trade close to the price of point C in anticipation of moving forward to point D or higher. 4. My stop is the loss of point C. If the price goes lower than point C, I sell and accept the loss. Therefore, it is important to buy the stock close to point C to minimize the loss. Some traders wait and buy only at point D to ensure that the ABT pattern is really working. In my opinion, that approach basically reduces your reward while at the same time increasing your risk. 5. If the price moves higher, I sell half of my position at point D and bring my stop higher to my entry point. 6. I sell the remaining position as soon as my target hits, or I sense that price is losing steam, or that the sellers are acquiring control of the price action. When the price makes a new low on my 5-minute chart, it is a good indicator that the buyers are almost exhausted. Strategy 2. Bull flag momentum. In day trading, bull flag is a momentum strategy that usually works very effectively on low float stocks under $10. This trading strategy is difficult to manage the risk in and requires a fast execution platform. Figure 7.3 - example of bull flag formation with one consolidation period. This pattern, shown above in figure 7.3, is named bull flag because it resembles a flag on a pole. In bull flag, you have several large candles going up, and you also have a series of small candles moving sideways. Or, as we day traders say, consolidating. Consolidation means that the traders who bought stocks at a lower price are now selling and taking their profits. Although that is happening, the price does not decrease sharply because the buyers are still entering into trades and the sellers are not yet in control of the price. Many traders who missed buying the stock before the bull flag started will now be looking for an opportunity to take a trade. Wise traders know that it is risky to buy a stock when the price is increasing significantly. That's called chasing the stock. Professional traders aim to enter the trade during quiet times and take their profits during the volatile times. That is the total opposite of how amateurs trade. They jump in or out when stocks begin to run, but grow bored and lose interest when the prices are, shall I say, sleepy. Chasing the stocks is an account killer for beginners. You must wait until the stock finds its high point, and then you must wait for the consolidation. As soon as the price starts breaking up in the consolidation area, you can begin purchasing stocks. As I've mentioned elsewhere, patience truly is a virtue. Usually a bull flag will show several consolidation periods. I enter in only during the first and second consolidation periods. Third and higher consolidation periods are risky because the price has probably been very extended in a way that indicates that the buyers will soon be losing their control. Let's study an example in figure 7.4 below of a bull flag on Regal on August 30, 2016. Figure 7.4 - example of bull flag formation with two consolidation periods on Regal. This is an example of two bull flag patterns. It is normally hard to catch the first bull flag, and you will probably miss it, but your scanner should alert you to it so that you can be ready for the next bull flag. Figure 7.5 that follows is an example from my scanner in this time period. Figure 7.5 - example of my intraday bull flag strategy. As you can see, my scanner showed Regal at 12:36 and 15 seconds p.m. As soon as I saw that, I realized that there was also a very high relative volume of trading, which made this a perfect setup for day trading. I waited for the first consolidation period to finish and, as soon as the stock started to move toward its high for the day, I jumped into the trade. My stop loss was the breakdown of the consolidation period. I marked my exit and entry on figure 7.6 below. Figure 7.6 - entry, stop and exit of a bull flag strategy on Regal. You can see the bull flag pattern on any short time frame, 1 minute, 2 minute and 5 minute charts. Now let's take a look at figure 7.7, a 2-minute chart for Opt on June 1, 2016. As you can see, the stock had a powerful bull flag right at the open, followed by a consolidation period. As soon as the first consolidation period was completed, another small bull flag formed. The volume of shares traded is significantly higher after consolidation, which is a confirmation for a long entry. You can also see another bull flag in the Opt 2-minute chart followed by another consolidation period. As shown below in figure 7.7, after the second consolidation period, the volume of shares traded was significantly higher, a confirmation for another long entry. I don't trade more than 2 bull flags in a stock and, As you can see in this chart, the stock started to sell off after the third bull flag. Aside from the strategy, did you notice that OP moved from $1.50 to almost $7 in just 35 minutes? This kind of move can be expected from low float under $10 stocks. Figure 7.7- screenshot showing 3 consolidation periods in OPT. Note the volume increases after each consolidation period. To summarize my trading strategy: 1. When I see a stock surging up, I patiently wait until the consolidation period. I do not jump into the trade right away. 2. I watch the stock during the consolidation period. I choose my share size and stop and exit strategy. 3. As soon as prices are moving over the high of the consolidation candlesticks, I enter the trade. My stop loss is the break below the consolidation periods. 4. I sell half of my position and take a profit on the way up. I bring my stop loss from the low of the consolidation to my entry price. 5. I sell my remaining positions as soon as my target hits, or I sense that price is losing steam and the sellers are gaining control of the price action. The bull flag is essentially an apt pattern that will happen more often on low float stocks. However, in a bull flag strategy for stocks under $10, many traders buy only at or near the breakout. The reason for this is because moves in low float stocks are fast and they will fade away very quickly. Therefore, bull flag is more or less a momentum and scalping strategy. Scalpers buy when the stock is running. They rarely like to buy during consolidation. These types of stocks usually drop quickly and brutally, so it is important to jump in only when there is a confirmation of breakout. Waiting for the stock to break the top of a consolidation area is a way of reducing your risk and exposure time in low float stocks. Instead of buying and holding and waiting, which increases exposure time, scalpers just wait for the breakout and then send their order. Get in, scalp, and get out quickly. That's the philosophy of momentum scalpers. Get in at the breakout, take your profit, get out of the way. The bull flag pattern is found within an uptrend in a stock. The bull flag is a long base strategy. You should not short a bull flag. I personally don't trade much momentum. It is a risky strategy and beginners should be very careful trading these. If you choose to, trade only in a small size and only after sufficient practice in simulators. You will also need a super fast execution system for scalping. Strategies 3 and 4, reversal trading. Top and bottom reversals are 2 other trading strategies that day traders love using because they have very defined entry and exit points. In this section, I'm going to explain how to find reversal setups using scanners, how to use indecision or doji candlesticks to take an entry, how to understand where to set your stops and your profit targets, and how to trail your winners. If you are part of our chat room, you will hear me say time and time again that what goes up must come down. Don't chase the trade if it is too extended. The inverse is also true. What goes down will definitely come back up to some extent. When a stock starts to sell off significantly, there are 2 reasons behind it. 1. Institutional traders and hedge funds have started selling their large position to the public market and the stock price is tanking. 2. Traders have started short selling a stock because of some bad fundamental news, but they will have to cover their shorts sooner or later. That is where you wait for an entry. When short sellers are trying to cover their shorts, the stock will reverse quickly. That is called a short squeeze. You want to ride that. I'm going to illustrate this strategy with a few examples so that you can see exactly what to look for. Figure 7.8 below is an example of what it looks like to find a stock that has sold off really hard right after the market opens. Moves like this are extremely hard to catch for the short side, because when you find the stock, it is already too late to enter the short selling trade. But please, remember the mantra, what goes up must come down. Therefore, you have the option of waiting for a reversal opportunity. Figure 7.8 example of a reversal strategy on EBS. Each reversal strategy has 4 important elements. 1. At least 5 candlesticks on a 5-minute chart moving upward or downward. 2. The stock will have an extreme 5-minute RSI indicator. And RSI above 90 or below 10 will pique my interest. The RSI, developed initially by famous technical analyst Wells Wilder, Jr., is an indicator that compares the magnitude of recent gains and losses in price over a period of time to measure the speed and change of price movement. The RSI values range from 0 to 100. Traders in reversal strategies use RSI values to identify overbought or oversold conditions and to find buy or sell signals. For example, RSI readings above 90 indicate overbought conditions and RSI readings below 10 indicate oversold conditions. If you want to learn more about the RSI indicator, you can do a Google search or ask me in the chat room. Your trading platform or scanner software calculates RSI automatically for you. These 2 elements demonstrate that a stock is really stretched out, and you must pay close attention to your scanner for all of these data points. I have configured my scanner to highlight RSIs lower than 20 and higher than 80 so I can very quickly recognize them. You must simultaneously look for a certain RSI level and a certain number of consecutive candles. 3. The stock is being traded at or near an important intraday support or resistance level. For details of how to find support or resistance levels, please read my commentary that follows for support or resistance trading. I only take reversal trades when the price is near a significant support level or a significant resistance level. 4. When the trend is coming to an end, usually indecision candles, such as a spinning top or doji, form. That is when you need to be ready. In reversal trading, you are looking for one of the indecision candlesticks that we reviewed in Chapter 6. They are an indication that the trend may soon change. A doji is a candle that has a wick longer than its body. You can see a picture of a bearish doji in figure 7.9 below. It has that long upper wick that some would call a top tail and that others would call a shooting star. This candle tells you 4 things: the open price, the close price, the high of that period, and the low of that period. So, when you have a candle with a top tail, you know that at some point during that candle period the price moved up, was unable to hold at that level, and was then sold off. It depicts a bit of a battle taking place between the buyers and the sellers in which the buyers lost their push-up. It is a good indication that the sellers may soon control the price and will push that price down. The same is true about a bullish doji. You can also see a picture of a bullish doji in figure 7.9 below. It has that long lower wick that some would call a bottom tail and others would call a hammer. When you have a hammer candle with a bottom tail, you know that at some point during that candle period the price moved down, was unable to hold at those low levels, and was bought up. This indicates a battle between the buyers and the sellers in which the sellers lost their push down. It is a good indication that the buyers may now gain control of the price and push that price up. Figure 7.9 top reversal strategy with an indecision shooting star candlestick formed as a sign of entry. In reversal trading, you look for either doji or indecision candlesticks. They are an indication that the trend may soon change. In reversal strategies, you are looking for a clear confirmation that the pattern is beginning to reverse. What you definitely don't want is to be on the wrong side of a reversal trade, or, as we call it, catching a falling knife. It doesn't sound like a good idea in real life, and it's not a good idea in trading. It means that when a stock is selling off badly, you don't want to buy on the assumption that it should bounce. If the stocks are dropping, you want to wait for the confirmation of the reversal. This will usually be the formation of a doji or indecision candle and the first 1 minute or the first 5-minute candle to reach a new high near an important intraday support level. That is my entry point. I set my stop at the low of the previous candlestick or at the loss of the support level. In reversal trading, it is best that the RSI be at the extremes. Once you find that, you must then look for an actual entry near a strong intraday support or resistance level. As mentioned, an entry for me is going to be either the first 1 minute or the first 5-minute candle to reach a new high or to make a new low, and only when the price is being traded near an important intraday support or resistance level. Figure 7.10 bottom reversal strategy with an indecision hammer candlestick formed as a sign of entry. In a bottom reversal, when you've had a long run of consecutive candles making new lows, the first candle that makes the new high near an important support level is very significant. That's my entry point. There are times when I'll use the 1-minute chart, but typically I'll wait for the 5-minute chart, because it is a much better confirmation. The 5-minute chart is cleaner. The first 5-minute candle to make a new high near an intraday support level is the point at which I enter the reversal, with a stop at the low of the day. Once you're in one of these trades, your exit indicators are quite simple. I take profit when the price reaches a moving average or reaches another important intraday level. In a bottom reversal, if the stock pops up and then suddenly moves back down, I stop out for a loss. If I jump in long, buying stock and hoping the price will go higher, and instead the price ends up just going sideways, it's a sign that I am probably going to see a consolidation for another move down, and that is an indication that the price is probably going to continue to drop. If I get in and I hold for a few minutes and the price stays flat, I get out, no matter what happens after that. I may be wrong, but I don't like to expose my account to the unknown. I need to be in the right setup, and if it is not ready yet, I'm out. If I get into the profit zone, I can start adjusting my stop, first to break even, and then to the low of the last 5-minute candle. I will then keep adjusting my stop as I move up. In reversal strategies, one of the main tasks of a trader is to watch stocks that are running up or down, while simultaneously identifying possible support or resistance levels and areas that could provide a good reversal opportunity on daily charts. This allows you to resist being impulsive and rushing into the trade. Instead, you wait for the areas of stagnation. You take your time and watch the trade develop and wait for the reversal to begin.